Build your dreams, live rich, and leave rich.
Welcome. My name is Krish, and this is Live Rich and Leave Rich. You know, the whole idea behind this show is really simple. Living rich isn't about fancy cars or huge houses. Not at all. It's about that incredible feeling of peace you get when you know your finances are sorted, when you have the freedom to focus on what truly matters to you and your family.
All right, before we jump in, we have to get our standard disclaimer out of the way, but please know it's really important. Everything we're going to talk about today is for your financial education. Think of me as your guide, helping you understand the map. But for your specific journey, for advice that's built just for you, you should always talk to a SEBI-registered financial advisor. They're the experts who can help you apply all these ideas to your own life.
Okay, let's dive right in. When you put your hard-earned money into a mutual fund, maybe through an SIP, what do you actually picture in your head? Come on, be honest. For a lot of us, it's kind of this, black box, right? Maybe you imagine some super advanced computer sitting on Delaw Street just crunching numbers. Or maybe you picture a single genius fund manager in a dark room surrounded by 100 screens, just magically picking the winning stocks. We hear the names, we see the ads, but where does our money really go?
And that leads to the other big question, a huge myth that so many of us fall for. You see a fund with this massive number next to it, 50,000 crore rupees in AUM, assets under management. And the first thought is, wow, look at that. So many people trust this fund, it must be the safest, it has to be the best one. But is that actually true? When it comes to managing your family's future, is bigger always better? Well, the answer might just surprise you.
So here's my promise to you today. Over the next 25 minutes or so, we are going to pull back that curtain. We are going inside the giant corporate machines that literally control trillions of rupees of our money right here in India. By the time we're done, you'll know exactly who is holding your money. You'll understand how these massive companies get incredibly rich doing it. And, this is the most important part, you'll understand why the size of a fund can sometimes be its own worst enemy.
So how are we going to do all that? Well, we have a clear roadmap. First, we're going to use a really simple analogy, a transport company, to make it all make sense. Then, we'll look at the creators, what an AMC really is. After that, we'll check the scoreboard and understand AUM. We'll also peek into the business model to see how these AMCs get rich. And finally, we'll tackle the big one, the elephant in the room, the problem with size.
Okay, so let's get started with our big idea. To make this all incredibly simple, just for a moment, I want you to completely forget about finance. Forget stocks, forget mutual funds. Instead, I want you to imagine a giant nationwide bus company. Let's give it a name. How about the Bharat Wealth Transport Corporation? And its only job is to safely transport people and their valuable luggage from one city to another, helping them reach their destinations. This one simple idea is going to unlock everything for us. So let's connect this to the real world. What is an asset management company, or AMC? You've heard the names, right? HDFC AMC, SBI Mutual Fund, and so on. Well, in our analogy, the AMC is the main bus company itself. It is the Bharat Wealth Transport Corporation. It's the big parent organization. They're the ones who own all the buses, they hire the expert drivers, they build the bus stations, they run all the advertisements, and they handle all the complicated paperwork with the authorities. It is a huge, professionally run business that manages the entire operation, from the top all the way to the bottom. Now, a big company like this doesn't just run one bus, right? Of course not. It has a whole fleet of them. It has a bus going to Delhi, another one to Chennai, and maybe a third one that takes a really adventurous hilly route. Each one of those individual buses is like a specific mutual fund scheme. The Delhi Large Cap Express bus has a very clear, safe destination. It's going to invest only in India's biggest top 100 companies. But the Himalayan small cap rider bus, well, that one's taking a riskier, bumpier road, investing in small, up-and-coming companies, hoping for a much bigger reward. See? Each scheme, just like each bus, has a different destination, a different route, and a totally different level of risk.
And finally, what about that term we keep hearing? AUM? It's actually super simple. AUM, which stands for Assets Under Management, is just the total value of everything being carried by the entire fleet of buses. You add up the value of all the luggage, all the cash, from every single passenger, on every single bus that the Bharat Wealth Transport Corporation is running today, and that grand total is the AUM. It's the one number that tells you how much wealth the company is responsible for right now.
Okay, so now that we've got that analogy locked in our minds, let's look at the real mechanics. And this is where things get really interesting. You see, SEBI, which is the main regulator for the markets in India, has set up a very, very specific structure for every single mutual fund. And honestly, it's pretty genius. It's not just one company running the show. It's a three-part system designed with one main goal in mind: to protect your money.
Now, this is a really crucial point, so let's break it down. There are three key players here. First, you have the sponsor. This is the big, famous parent company. Think SBI or HDFC Bank. They're the ones who give the fund its name and credibility. In our analogy, the sponsor is the founder of the bus company. They provided the initial money and their well-known brand name to get the business started. Second, and this is probably the most important part for you as an investor, you have the trustees. This is an independent group of people, a board that is completely separate from the company. Their only job, their single most important duty, is to protect the interests of you, the investor. Think of them as independent safety inspectors. Their job is to constantly check the buses, make sure the drivers are qualified, and audit the company's accounts to ensure that none of the passengers' luggage, your money, is being mishandled. They are your watchdog. They work for you. And third, you have the AMC, the asset management company. This is the operations team we talked about. The CEO, the fund managers, our bus drivers, the research analysts, and all the staff doing the day-to-day work. This three-part structure makes sure that the people managing your money are being watched over by another group of people whose only job is to protect you.
All right, so now that we understand that protective structure, let's talk about the main scoreboard for this whole industry. That big number, the AUM. It's the number that tells you just how big a fund house has become. But how is it actually calculated? And more importantly, how does it grow?
Well, the math behind it is actually incredibly simple. Let's just do a quick thought experiment. Imagine a brand new mutual fund scheme is launched. And let's say 1 lakh regular people from all over India, people just like you and me, decide to invest a modest 10,000 rupees each. What do you think the fund's starting AUM would be?
It would be 100 crore rupees. That's it. It's truly that simple. AUM isn't some complex number that comes from the stock market. It is literally just the sum total of money collected from every single investor. It's our collective wealth all pooled together in one place.
So what's really fascinating is how that number grows. There are really only two ways it can happen. The first way is through what we call inflows. In our bus analogy, this is when new passengers buy tickets and get on the bus. Every time someone starts a new SIP or puts in a lump sum amount, they're adding fresh money to the pot, and the AUM gets bigger. The second way, which is just as powerful, is through appreciation. Let's say our fund manager took that initial 100 crores and invested it brilliantly in a bunch of stocks. Over the next year, those stocks do really well and their total value grows to 110 crores. Well, guess what? The AUM of the fund has now grown by 10%, even if not a single new investor joined. So it's a mix of two things: new money coming in and the existing money growing on its own.
Okay, this brings us to a very, very important point that a lot of new investors just don't realize. These asset management companies, they're not charities. They're not government services doing this out of the goodness of their hearts. They are for-profit businesses, many of them listed on the stock exchange, with a duty to make money for their shareholders. And their entire business model revolves around that one number, AUM. So how do they make their money? They do it through something called the expense ratio. The easiest way to think about this is like the ticket price for your bus journey. It's a small annual fee, maybe around 1%, that the AMC charges on the total AUM that it's managing. This fee is automatically deducted from your investment's value over the year, so you don't really see it come out. And that money is used to pay for everything: the star fund manager's huge salary, the team of researchers, the office rent, all the advertising, and of course, what's left over is profit for the company.
And this chart, wow, this really shows you why AMCs are absolutely obsessed with growing their AUM. Just look at the power of scale here. If a fund has an AUM of 100 crores and they charge a 1% expense ratio, their revenue for the year is 1 crore. Okay, that's a decent amount of money. But now look at that other bar, a giant fund with an AUM of 50,000 crores. That same 1% fee now generates a jaw-dropping 500 crores in revenue for the AMC every single year. This is it. This is why their entire business is a race to gather as much of our money as possible. The bigger their AUM, the richer the AMC becomes.
And that, my friends, brings us to the most important lesson of this entire session: the elephant in the room. We've just seen exactly why the AMC wants its AUM to be as massive as possible. It is fantastic for their business. But, and this is a really big but, is a giant AUM always good for you, the investor? This is where we have to understand that size can be a double-edged sword.
You see, the critical point is this: it all depends on the type of fund. For a large-cap fund, one that invests in India's biggest, most stable companies like Reliance or TCS, think of them as the giant blue whales in the stock market ocean. A massive AUM of, say, 30,000 crores is actually a good thing. It gives them stability, it gives them scale. But for a small-cap fund, one that is supposed to be investing in tiny, emerging companies, the small fish of the ocean, that exact same 30,000 crore AUM can be an absolute nightmare. It creates a massive problem called liquidity, which is just a fancy word for being able to move around easily.
Let me give you a simple analogy to make this perfectly clear. A giant AUM in a small cap fund is exactly like trying to shove a full-grown elephant into a tiny little village shop. The elephant is huge and powerful, no doubt about it, but in that small room, its size becomes its biggest weakness. It can't turn around without knocking everything off the shelves. It can't take a single step without breaking the furniture. It's just too big for its environment.
So, let's look at the real-world problems this elephant faces. First, a fund manager who has 20,000 crores to invest simply cannot buy a meaningful amount of a small company's shares. If he tries to buy a big chunk, his own buying pressure, the elephant taking a step, will shoot the stock price up before he's even finished buying. Second, he cannot sell easily either. If he decides it's time to exit a stock, selling his huge position would flood the market with shares and crash the price, hurting his own investors. The elephant tries to leave the room and the door frame collapses. So what does this force him to do? Well, either he buys tiny, insignificant amounts of hundreds and hundreds of different stocks, which becomes impossible to manage, or worse, he starts to deviate from his goal and just starts buying bigger, mid-cap stocks because that's the only place he can park all that cash. The fund literally becomes too big to do the job you hired it for.
So what's the big takeaway from all of this for you as an intelligent investor? It's simple. When you're looking at a mutual fund, especially if it's a mid-cap or a small-cap fund, do not just look at the 5-star rating. Don't just look at the past one-year return. You absolutely must look at the AUM. You have to ask yourself, is the size of this fund, is the size of this elephant appropriate for the room it's supposed to be operating in? This single check is something most investors completely forget to do, and it's so important.
So from now on, when you look at a fund, don't just ask, is this a good fund? The intelligent investor asks a much smarter question. Is this fund an elephant, and is it in the right-sized room? Understanding that one difference, that simple but incredibly powerful concept, is one of the real keys to living rich and, more importantly, living peacefully. Thank you so much for joining me.